Okay, let's jump right into this explainer and try to unravel one of the wildest contradictions in the retail market right now. Something really doesn't add up over at GAAP. As we dig into their recent earnings, we see a company where total sales actually fell by 2%, and yet investors seemed absolutely thrilled. It's a giant puzzle that has Wall Street talking, and we're going to break it all down to see what's really going on under the hood.
Now, the blatant contradiction here is just fascinating. Gap's biggest brand, Old Navy, is actively shrinking, with comparable sales down 4%. Athleta was down 12%, which dragged total company sales down with it. Yet Wall Street aggressively bid the stock higher, jumping roughly 15% in extended trading right after the report dropped. Make it make sense, right? If the biggest brand is weakening, why on earth are investors suddenly so optimistic?
Well, that brings us to the literal $24 billion question. We need to figure out if this is a genuine business transformation or just an accounting mirage masking slower growth. So let's put on our financial detective hats and peel back the layers of their Q2 earnings report. Because once we look past the headlines, the story completely changes. Don't make up your mind just yet.
At first glance, this massive headline earnings per share number looks like a spectacular win. GAAP reported $1.38 in GAAP diluted EPS. Now, if you just casually skim the news, you might think, wow, business is booming. But professional investors immediately ask the follow-up question: where exactly did that profit actually come from? Here's the crucial point. When we strip away the one-time accounting benefits, we uncover the true recurring retail operation underneath. We start with that impressive $1.38, but then we have to back out a massive $417 million adjustment related to a tariff recovery. That one-time benefit artificially exploded their reported gross margin. You take that away and you reveal the true adjusted EPS of just 52 cents. That's our clean number. But wait, here's the catch. If sales are falling, how are they still pulling off a decent adjusted profit?
This brilliantly illustrates exactly how Gap is currently surviving. They're selling fewer items, but they are making more profit on every single item they do sell. Their adjusted gross margin actually ticked up slightly to 41.4%, and they hit a 7.1% adjusted operating margin. They're essentially raising their average unit retail across the board. But you and I both know there's a ceiling to this strategy. You can't just keep raising prices to offset falling foot traffic forever. Eventually, real human beings have to walk through the doors.
When we step back and look at how this entire portfolio pieces together, Old Navy is the undeniable beating heart of this company. Just look at the sheer scale. In Q2, Old Navy generated $2.1 billion in sales. The namesake Gap brand was a distant second at $844 million. Banana Republic and Athleta barely make up a fraction in comparison. Old Navy represents well over half of the company's entire quarterly sales.
Which leads us to a pretty harsh reality. If Old Navy fails, the rest of the portfolio simply cannot carry the weight. And right now, Old Navy is sending out distress signals. Despite pulling in over $2 billion in sales, their comparable sales are down 4%, and foot traffic is visibly slowing down. Management openly admitted they completely missed the mark with their women's summer seasonal assortment. We're talking dresses, shorts, and swimwear.
So who is going to fix this massive engine? Well, Gap is bringing in some seriously heavy-hitting executive talent. They announced Michael Francis will take over as president and CEO of Old Navy. The guy comes with serious credentials, including advising Walmart during a period of massive revenue expansion. But check out the start date, November 2026. That is a lifetime away in the retail world. As an investor, a new CEO starting that far out is purely a hypothesis until we see actual financial results. It shows Gap knows they need a totally different level of execution, but we're going to be waiting a while to see the real impact.
What exactly is his team going to do in the meantime? Well, these are the specific strategic levers they plan to pull. Obviously, they have to fix that women's seasonal assortment and get their value pricing back on track. They also want to turn Old Navy into a massive destination for denim. But look at that last point. They recently launched Old Navy Beauty Co. Think about it. $20 beauty products could be the perfect Trojan horse. It's a brilliant strategy to drive higher customer frequency without relying solely on people buying seasonal clothes.
Now, while Old Navy is struggling to find its footing, we have to contrast that with an incredible double-digit surge from the namesake Gap brand, a positive 10% in comparable sales. Management actually noted that Gap just delivered its strongest performance in decades in key categories like denim and fleece, all fueled by some highly culturally relevant marketing.
When we view the four engines of this vehicle all together, we're looking at a deeply complex portfolio turnaround. It's essentially a tug of war, where the winners are desperately trying to outpace the losers.
Old Navy and Athleta are currently dragging the company down, while Gap is absolutely surging and Banana Republic is steadily improving. Investors are basically betting that these strong brands can buy management enough precious time to fix the leaks at Old Navy.
But then, management dropped their future guidance and revealed another massive contradiction. They actually lowered their full-year sales outlook to a mere 1 to 1.5% growth. Yet, simultaneously, they raised their adjusted earnings per share guidance. This puts immense pressure on their ability to maintain incredibly strict cost discipline. They are explicitly telling us, look, we won't sell as much clothing, but we are absolutely going to squeeze more profit out of every single shirt we do sell.
So with all this uncertainty, why aren't investors running for the exits? Simple. Gap is aggressively throwing cash at its shareholders. Just look at these numbers. They are sitting on $2.5 billion in cash. They've already bought back $601 million worth of their own stock this year alone, and they're paying a totally sustainable quarterly dividend. When a company is buying back shares and paying a solid dividend out of positive free cash flow, they are literally paying you to wait for the turnaround.
However, we have to keep our detective hats firmly on. With inventory sitting flat year over year at $2.3 billion, we have to watch this metric like a hawk. Remember that weak summer assortment at Old Navy? We have to make sure that unwanted seasonal merchandise doesn't just sit collecting dust in warehouses, because that will inevitably turn into a margin-crushing markdown problem in the very next quarter. Plus, we have to objectively acknowledge the external threats out in the real world. Apparel is highly discretionary. It's a want, not a need. A squeezed consumer who's dealing with inflation, energy prices, and broad macro headwinds can simply decide to delay buying clothes, trade down, or just wait for massive promotions. If the consumer taps out, it could entirely wreck this delicate turnaround Gap is attempting.
So, how does this all end? Objectively speaking, there are 3 ways this plays out. We could see a true turnaround, Old Navy recovers, margins expand, and the stock gets rewarded with a much higher valuation. Alternatively, we might just see stabilization. Old Navy stops the bleeding, creating a respectable business with moderate returns. Or there's the failure scenario. Old Navy deteriorates even further, and the stock plummets right back to its previous lows.
And that brings us right to valuation. Because the stock has already rallied significantly from its recent low of $18.11, investors are no longer buying at the absolute ground floor. The market has already priced in some of this hoped-for recovery. The risk-reward balance has shifted. So you have to ask yourself, are you paying for a cheap stock today, or are you paying a hefty premium for a turnaround that hasn't actually been proven yet?
Depending on your personal strategy, your approach to this stock is going to look very different right now. If you're looking for a safe, predictable compounder, you should probably wait. The execution risk is just too high. If you're a turnaround investor willing to take a calculated risk for that dividend and buyback momentum, it could be a selective buy, but definitely keep your position sizing smart. And if you already hold it, you hold and watch. The thesis hasn't broken yet, but you absolutely must monitor Old Navy.
In fact, I highly recommend you jot this down or take a screenshot. I call this the 5-number truth machine. These are the exact 5 metrics you must watch in their next earnings report to completely cut through the PR noise and see if the turnaround is real. Ignore the headline revenue. You want to look at Old Navy comps, foot traffic, inventory levels, adjusted operating margin, and free cash flow. If those 5 move in the right direction, the turnaround is genuinely happening.
Gap doesn't actually need every single brand to win. It just desperately needs its biggest brand to stop losing. I'll leave you with that provocative thought to consider, because the next set of numbers will ultimately decide if this recent stock rally was a brilliant opportunity or a carefully disguised trap. Thanks for joining me on this explainer. Keep your eyes on those 5 key numbers and never stop questioning the headlines.